All right, folks, so what I want to do here is do a quick review of Able Trend, and then I'm going to compare that to bar charts, and I'm going to give you what my big picture view is. I frequently try to, well, daily, I try to assess what the macro view of the market is, and that doesn't always mean that I'm immediately correct. So if I say I think that there's a bias to the downside, that doesn't mean to imply that that's going to happen immediately next day or two. And sometimes I need to cover position or manage positions because I might jump in a little bit early. But if you look at the charts that Michael has in front of you right now, you see the red dot that's formed on NDX on the 3-9 minute, and that's indicating that there's a possible sell signal. But right below it, you have the 515 chart. So that sell signal it's actually a valid sell signal, but if you look at the 515 and maybe you put your cursor down there, Michael, you show where the level of support is. So 45.61, the index is trading at 45.63. So what that's telling us is, although, and the sell signal just went away, but although that sell signal has now reappeared, we want to be a little careful if we want to be conservative traders. If you want to be a more aggressive trader, you can jump in as soon as you see that sell signal and take a trade to the downside. But conservative approach would be to compare a couple different time periods. Our preferred time periods on the Able Trend charts are 3-9 and the 515. And when we look at the 515, we see that there are green bars, which means there's no commitment up or down. There is a blue dot, which indicates 15-minute support. And so if we did move lower, we'd need to break through that support in order to be able to build a position that would be profitable. So that's a good example right there of maybe being a little suspect, being a little careful and conservative on your entry. Now, if we shift over to SPX and you look at the 3-9, the 3-9 printed a sell signal on SPX. And it's the same discussion that we just had. You want to be a little suspect about that because on the next bar, on the next 3-9 minute bar, we printed 9-minute support again. So 9-minute support printed, you want to be careful in that area. And right now the bars turned green again and started to track back higher. And if you look at the chart below it, the 515 on SPX is showing a line of support at 2139.50. So we could move lower, but there's not enough room to move to get a profit by buying a long put right now. There's not enough room to move to lock in and leg into our put spread the way we'd normally want to do. So this is a great example of why sometimes there are these periods of quiet. There's a lull for us in the live trading room. Active trading, which the live trading room is, doesn't mean that you are in the middle of activity every single moment of the day, of the market day. There can be extended periods of time where we're frankly just waiting because we're not willing to commit capital to a trade that looks a little suspect, or we have other positions that we are managing or adjusting, and we're being very thoughtful and careful, as always, about the placement and use of our capital. So those two indexes, NDX and SPX, to me, look like they might be hinting towards perhaps some weakening pattern, but nothing at all has even come remotely close to confirming it. And then if we just take a quick look at RUT, the 3-9 minute, there's nothing at all in the same time period as NDX and SPX that would indicate that there is weakness. We're trading right in the sweet spot. It's double stacked to the upside on the 3-9. We're right at 5-minute resistance. We're double stacked to the upside on the 515. So all of that collectively tells me that probably want to just sit tight and wait, unless you're in a situation where you got a ton of capital and you don't mind maybe opening one contract, or you have a completely white screen, you have no positions open. I have a tendency to be slightly more aggressive when I have no positions open. If I have positions open and I'm managing a few of them, I tend to be a bit more conservative. So I'm looking for new positions now because I've spent some time today looking at managing a couple of the positions I have, kind of know what I want to do and what I don't want to do. So I'm back to looking for new positions, and I'm going to keep a close eye on the 3.9 and the 5.15 charts. Michael, any other comments you want to share about the Able Trend charts, those
Yeah,
patterns?
Mark, I was thinking about actually going short here on the 3 minute chart, but then 9 minute just printed. So now I've got to wait four more bars to the right of this last 9 minute support before I can go short because it could print again.
Yes.
So you can see it printed there. And I was going to actually go short right here. I really was until that
Mhm.
printed. And I said, nope, not going to do it. So,
Okay. All right, that's good clarification. But we are starting to see red bars, right? We have a
yes,
sell
yes, we
signal, we
are.
have a red bar, and this is the first time I believe all day that we've had 3-minute resistance printing.
Yes, it is.
So those again are clues. Don't get too anxious if you want to be a conservative trader. Those are clues that maybe we are starting to see some weakening of the momentum and that we're going to see some sort of a down cycle develop. Just clues, they're hints at it. The market has not yet told us that that's what it wants to do. And for me, one of the things that I would really want to pay attention to is the 515 chart. Um, there's one thing I just noticed about 515, Michael, is that 5-minute support quit printing. So we have 15-minute support at 45.61, but
Yes.
5 has quit. So the fact that 5 has quit printing, at least as of now, the fact that 3-minute resistance has started printing, you've got a sell signal on the 3, and um, 9-minute support just printed again.
Yes.
So how do you feel about going short now that 9-minute just printed again?
I would not go short here.
Okay, even though you've got 3-minute resistance,
No, I wouldn't be in between. I wouldn't take a trade here just
even though
because of the nine.
even though 5-minute support quit printing.
Mm-mm, not with 9 minute printing. I wouldn't do it.
Well, it's a lot easier to trade with someone else's money. So if you need me to make that trade for you using your account, I can do
You go
that.
ahead. Okay, I give my paper account number.
All right, let's take a quick look at. Oh, I'm sorry. Anything else on SPX or RUT?
No, they're the same. You got support underneath of them, and I just RUT. I mean, the 3 minute has stopped printing, but I wouldn't. I'm gonna take your thing right here, right now.
Yeah, my takeaway from those 6 charts right there is that it's not a time to take a trade, but it looks like things may be starting to weaken, or we could look back an hour from now and realize that was just a little bit of a pause.
That's true.
Now, I do want to say this before we jump to my bar charts. If you're going to be a conservative trader, there are some opportunities you're going to miss. Like NDX is starting to move lower, that may turn out to be a opportunity that you miss.
There
But
was a 5 minute sell signal mark on the NDX now.
there you go. So you have to come to terms with your own emotions when it comes to trading. You need to, if you are going to be committed to being a conservative trader, which is exactly what Michael's doing right now, then you need to be resigned to the fact that there are going to be some opportunities you're going to miss. But Allison, one of our other team members, made a great point earlier today that when we think about the opportunities that we missed, we often don't think about the managed trades that we also missed out on by being conservative. So just decide how conservative or how aggressive you desire to be. It should be based on your own appetite for risk as an individual trader. It should be based on the capital that you have available to trade and the capital you're comfortable putting into these trades. I like what I am starting to see right now. But let's just take a quick look at my bar charts also, and I'll give you my perspective based on that. I'm going to pull the view over to me here, Michael.
Okie doke.
Okay, you see that okay?
Yes, sir. See it fine.
All right, so I'm on a 1-year daily bar chart on NDX. And I, I still see that we are in an overall declining channel. And this red channel has been in place for quite some time. We've talked about this before on other uh, bar chart reviews. What's been variable is the angle of the short-term pattern. So the angle of the short-term pattern has changed, but the angle of this declining red channel, this declining channel has been in place really since back in September of last year, has not changed. And what we've seen is that today we moved right up to resistance of that declining channel. We moved right up to resistance, which was also right at the 2 standard deviation Bollinger Band, and actually formed a slight Bollinger Band snap on the daily chart. So we're trading at long-term resistance. And if you haven't been through this exercise before, let me just give you a couple of quick tips. In my opinion, support and resistance channels are a very valuable tool to give yourself a macro view of what's going on whatever equity you're trading. We have a natural level of resistance here, natural level of resistance here. When I say natural level of resistance, those are price points where the market moved up to that level and then moved away from that level, not because there was a line drawn there, but that's where the market decided to stall and head in the other direction. So if you line up all your natural levels of resistance and you can tie them together with a single line, it gives you an idea of where there exists naturally in the market a level of resistance. Today, we came right up to that natural level of resistance line that had been defined prior, and we turned away from it. Now you can see it pretty clearly when you drop down to a 10-day, 10-minute chart, and you see how we moved right up to that level and started to drift away from it. I wouldn't say we've moved away from it significantly yet, but the first hint of drifting away from it has started, and now we just have to wait and see whether we turn and head higher or whether we drift lower from here. So that's point number one. Point number one is we traded up to a declining line of resistance. Point number two is we traded into a Bollinger Band snap pattern. That's a daily Bollinger Band snap pattern. So generally, when you see a Bollinger Band snap pattern, the market is telling you that in the not too distant future, which could be within the next hour or could be within the next week, there is likely to be some sort of a movement back to the downside. Sometimes when the Bollinger Band snap pattern hits like it did here, it'll continue to move higher before then ultimately it does move lower. And just to give you an idea of the magnitude of this pattern here, it's a 388 point range right here. So we're trading at the top of a 388 point range. We were at the bottom of that range as recently as the 27th of June. We were at the top of that range, and I'm going to say the top, we didn't get all the way up to that level of resistance, but we formed a natural level of resistance on the 3rd of June, and the previous bottom, although it wasn't all the way down to the bottom, was on the 19th of May. So you can see that there are cycles up, cycles down, cycles up. So let me just tell you again in summary, strong level of resistance, which doesn't mean it will hold. We could continue to press higher. Bollinger Band snap on the daily, pointing to a possible movement lower. And then as I zoom in, I want you to also see that there is an oops pattern between yesterday and today. There was an oops pattern between Thursday and Friday. And there is an oops pattern back here from the 28th into the 29th. So there are 3 oops patterns in the last, I believe, 9 trading days. 3 oops patterns in the last 9 trading days. And why is that significant? Because in my experience of trading and following oops patterns, they satisfy about 93% of the time. And so what that means is that the price will eventually trade back down to the high of the bar before the gap. So it'll trade back down to 45.29.72. It'll trade back down to 44.68, and it'll trade back down to 42.91. Those are the OOPS patterns, and in order to satisfy all three of those OOPS, the NDX will eventually trade back down to 42.91. 93% of the time, OOPS patterns are satisfied. So that means 7% of the time they aren't. And we know that, but there's a statistical probability that we will trade back down to the 42.91 range, and it's well within the channel that we're trading in. There are two patterns that I'm looking at. It's the declining red channel right here that we already talked about. We moved right up to resistance of that today. And then there's a sideways pattern where all of the most recent activity since about the end of April has traded in this sideways pattern. And you can see the down cycle, you see the up cycle, followed by the next down cycle, and now we're in a current up cycle. If we traded back down to support of this sideways pattern, support is at or around the 41.87 level. Is it realistic that we could get down there? You know, some people would look at the fact that we've been on such a strong rising pattern here for the last 9 days, and that we're trading at 45.64. They might poo-poo the fact that actually we could trade back down to that level. But those are some of the same folks that would have doubted that we could have moved from a high of 45.23 down to a low of 41.79 in really just a matter of about 2 weeks. So the cool thing about the indexes and trading the indexes is they do have consistent patterns and cycles. You can be guaranteed that after you reach the end of a rising cycle, there's going to be a declining cycle. The trick is trying to identify where the end of the rising cycle is. And we have a couple of very basic tools that start to give us hints as to where that is. One is the bar charts, which I'm sharing with you, and OOPS patterns and levels of resistance and Bollinger Band snaps, etc., those types of things. But the second one is the longer term able trend charts. If you start taking a look at 30 and 90 minute time periods and 60, 180 time periods, when those time periods start to indicate sell signals, red bars, and potential pattern adjustments, those are things to really pay close attention to. One other thing that I will show you here is on the 10-day, 10-minute, if I just layer in some of our more advanced studies, the awesome oscillator, the AO, is indicating a declining Twin Peaks pattern. So what that means is you've got a series of green and red bars. Red indicates weakening momentum. Green indicates strengthening momentum. I'm looking at this on a short-term intraday time period. But when you have a series of transitions from green to red, you have a series of peaks. If those peaks are in a pattern where each subsequent peak is a lower high, that indicates overall weakening of momentum. So right here, we have weak momentum occurring, and during that same period of time, we have pretty strong price action moving higher. So the difference between those two is what we call divergence or angulation between rising price and declining momentum. And eventually the price loses out because you can't continue to sustain rising price with weaker and weaker momentum. Again, this is one of those indicators that is a hint, it's a clue, but it's not intended to be an actionable take a trade immediately now, because we could continue to walk along this rising price trend line for a while, and we could continue to see weakening momentum. But the longer these two spread apart and the wider they spread apart, the greater likelihood is that there will be a reversal, and that reversal will be more dramatic, the more significant that divergence is. So overall, that's what I wanted to share with you. We will take a quick look here at the 1-year SPX, and won't go into quite as much detail, but let's take a look at SPX. Very similar pattern. I haven't looked at the bar chart on SPX yet today, but the first thing I notice on the daily chart is that we have trading right at resistance, right at a long-term line of resistance. Let's just back up and see how far back that goes. Go back to a 2-year time period here. Okay, so we can go back to May 21st, 2015, so over a year ago. And on that day, we hit an all-time high on SPX, 2134.28. Today is the first time since that date that we broke that high, and we hit a high of 2143.16. So that would tell me that we have a natural level of resistance on May 20th of 2015, so over a year ago. You can see where we had some natural levels of resistance after that, but none of them exceeded that 2134.72 price until today. And so today we moved up to that natural line of resistance, but we haven't confirmed it yet because frankly, we're still trading at or around that high. I don't consider it confirmed until we see the price starting to fall away from that line of resistance. But for all practical purposes, you can see here that in the past year, a little over a year, we've traded in this range on SPX that has been a 331 point range, from an all-time high down to a low of, see, that low was 1810. Yeah, 1810 was the low. Yeah, 1810.10 was the low on February 11th. So that's been quite a range, and then we moved from 1810 all the way back up and broke out of the high 2134 and formed a new all-time high. We're trading right at the upper Bollinger Band. It's not a Bollinger Band snap like it was on NDX, but we do have an oops pattern to satisfy, and that means that the index would trade back down to 2036.09 to satisfy that oops pattern. There's only one, I believe there's only one, yes, there's only one oops pattern in the last 9 days, and so that would take us down to 2036.09. So we'll see whether or not that occurs, but you know, folks, this is just my personal point of view, and I wouldn't necessarily go trade off of this, but maybe just have your own perspective. When I see an index hit a new all-time high, I look at that as a natural headwind. We might exceed that all-time high. We might establish, another new all-time high tomorrow, etc. But when it starts getting into that range of multi-year highs or all-time highs, the indexes tend to start running out of steam. And you can see here that we're trading at a level of resistance. We're trading at a new all-time high today. We're trading at the upper Bollinger Band on the daily chart. I mean, just to move back down to the lower Bollinger Band on the daily chart would put us down to 2020. It's 120 points below where we're currently trading. Last time we were trading there was as recently as the 27th of June, where we were trading at a low of 1991. And here we are trading at 2141. And we've made that move very strongly just since the 27th of June. So this is why I maintain a personal belief that we have an overall macro view of the market of a declining bias. I could be wrong, but I'm going to trade according to that. Each of you, when you're trading, should always trade according to what your personal belief is and your personal view of the market. You're going to be wrong on some trades. That's just something that you have to accept. You're going to be right on a lot of trades. That's also something that you have to accept and enjoy. But trading is a balance between your adopting your view of what the market is showing you, then using the signals that you feel comfortable with to enter new trades, and keeping yourself aligned to the directional bias that you believe is the strongest directional bias out there. Most of my portfolio is aligned to the downside, although I've got some iron condors, so I take benefit from rising bias as well as declining bias. But I might be stubborn, um, and I've been told that sometimes, but I'm sticking to an overall weighted bias to the downside, but it doesn't prevent me from taking rising bias trades when I see them as opportunities. What it does is it influences me as to how I open that rising bias trade and how I position it so that I can easily cover myself. In my case, I want to be able to convert it into a credit spread if in fact the index or the price reverses against me. So that's a summary of the charts for today. That's my personal perspective on where we are trading and where we could possibly go. SPX, I mean, the support here on this sideways trending pattern is around 1807. That'd be a pretty big move down, but then again, we made a pretty dramatic move down earlier in the year, made a dramatic move up. We've had fairly significant moves. That's what these indexes do historically. I don't think we're going to all of a sudden today stop making significant moves and forming declining cycles as well as rising cycles. I mean, that essentially is the history of the market. And it's up to us to interpret and decide when it's most appropriate for us to enter a position. So, Michael, can we switch back to your charts and just take one quick last look?
Yes, sir. Let me switch them over, Mark. You'll have to. There we go. Thank you, sir.
I wanted to go back and look at them real quickly again because I've been
Getting
watching
it.
out of the corner of my eye how that NDX has been developing.
Yes.
And so we were talking before about that sell signal and that 3-minute resistance started printing. 9-minute support has now quit printing if the current bar prints, and 9 minutes not there. So it does look like we're starting to form some weakness, and there may be some opportunities for us to take some trades. So I'll let each of you get back to focusing on your trades, and I hope this is helpful to you. And we'll continue to provide updates and our thoughts on trades as we place them. Remember, the purpose of the live trading room is for myself and my team to trade, and we share with you the trades that we are placing. We're not recommending trades for you. We're not suggesting that you do something, but we are, full disclosure, showing you exactly what we are doing, and we're explaining why. Sometimes we're wrong. Sometimes we're premature. Sometimes we miss opportunities. Those are all natural parts of trading. In the big scheme of things, though, overall, we do very well. And you're welcome to follow along with us if you think that's right for your account. All right, thanks, everyone.